Investing in crypto the right way. In 2010, a man spent 10,000 Bitcoin on a luxury car. At the time, it felt reasonable. Today, that Bitcoin would be worth hundreds of millions of dollars. But here's the uncomfortable truth. For every person who became wealthy from crypto, thousands lost everything. So the real question isn't, can crypto make you rich? It's this. Why do some investors win, quietly, consistently, while others get wiped out? This isn't about hype. It's not about overnight riches. It's about investing in crypto the right way, with discipline, clarity, and long-term intelligence. If you stay until the end, you'll understand not just what to buy, but how to think like the investors who survive every cycle. What crypto really is. Most people think crypto is about prices, charts, candles, green days and red days, up today, down tomorrow. And that mindset is exactly why most people lose. Because crypto isn't a stock, and it isn't just digital money. At its core, crypto is something far deeper. It's a re-architecture of trust. For thousands of years, human civilization has relied on institutions to decide what has value. Banks verify transactions, governments issue money. Middlemen keep records, approve transfers, and take their cut. We trusted them because we had no alternative. Then came 2008. The global financial crisis didn't just crash markets, it shattered confidence. Banks that were supposed to be safe collapsed overnight. Governments printed money to save the system, quietly diluting everyone else's wealth, and ordinary people paid the price for mistakes they didn't make. That moment revealed a dangerous truth. When trust breaks, money breaks with it. Bitcoin was born from that failure. Not to make people rich, not to create overnight millionaires, but to answer a single question. What if trust didn't require institutions at all? Blockchain technology introduced something radical, a system where transactions are public, records are immutable, and trust is no longer enforced by authority, it's enforced by math. No central gatekeeper, no hidden ledger, no permission required. Every transaction can be verified by anyone. Once written, it cannot be quietly altered. Rules apply equally, whether you're powerful or unknown. That's the real innovation. Crypto isn't about escaping work. It's about escaping blind trust. And here's the danger. If you don't understand this, you'll treat crypto like a casino. You'll chase pumps, you'll follow noise, you'll gamble on price instead of understanding purpose. And casinos are engineered for one outcome. The longer you play without understanding the system, the more certain the house wins. Crypto was designed as an alternative to that system, not a shortcut through it. Understand that difference, and you stop speculating. You start investing with clarity, patience, and intent. Why most people lose money. Every bull market brings new believers, new experts, new profits, new success stories, and every crash exposes the truth. Because markets don't test intelligence, they test behavior. Most investors don't fail because crypto is broken. They fail because human psychology is predictable, and it usually collapses in 3 stages. First, they enter late. They don't buy when prices are quiet. They buy when everyone is talking, when headlines scream new highs, when screenshots of profits flood social media. By the time the crowd feels safe, risk is already elevated. What looks like confirmation is usually exhaustion. Markets reward early conviction, or not late excitement. Second, they chase narratives, not fundamentals. They don't ask what a project does, they ask how fast it's moving. Memes feel good because they're simple. They promise belonging, speed, and easy wins. But real technology is boring before it's valuable. It requires patience, understanding, and time to compound. Narratives change every cycle. Fundamentals are what survive the cycle. If you don't know why something has value, you won't know when that value disappears. Third, they have no exit strategy. This is the most expensive mistake of all. They never decide in advance when to take profit, so greed takes over. They never decide how much loss is acceptable, so fear takes over. Hope becomes a strategy, and hope is not risk management. Markets don't reward excitement, they reward preparation. Crypto, more than any other asset class, amplifies mistakes. Gains happen fast, losses happen faster. There are no circuit breakers for emotion, no mercy for overconfidence, no protection from yourself. If you treat crypto like gambling, it will treat you like a gambler. And gambling always ends the same way, not because the player is stupid, but because the system is designed to punish impulsive behavior. Crypto doesn't humble people randomly. It humbles those who confuse noise for knowledge and excitement for strategy. Survival belongs to the prepared. The difference between trading and investing. Most people say they're investing. What they're really doing is trading. Trading is about timing. Investing is about conviction. Traders react to price. Investors study value. Long-term crypto investors ask different questions. What problem does this protocol solve? Who is using it? Can it survive regulation? Will it exist in 10 years? They don't check charts every hour. They check fundamentals every quarter. If you don't know why you own a coin, price volatility will scare you out of it. The core principles of smart crypto investing. There are principles that separate survivors from victims in crypto. Not intelligence, not luck. Principles. Because markets don't destroy people randomly, they expose those who ignore reality. Principle 1. Bitcoin is not optional. Bitcoin is the foundation of the entire crypto market. It is the reserve asset, the benchmark, the gravity that everything else orbits. When Bitcoin moves, liquidity moves. When Bitcoin weakens, risk assets bleed. When Bitcoin is strong, confidence returns. Ignoring Bitcoin while investing in crypto is like investing in stocks without understanding the dollar. You might get lucky, briefly, but you'll never understand why the market behaves the way it does. Bitcoin isn't just another coin, it's the reference point for trust. Principle 2. Most altcoins will die. This is uncomfortable, but necessary. Innovation is expensive. Attention is temporary. Competition is ruthless. Every cycle creates thousands of new projects. Only a handful survive the next one. Many tokens exist because markets are euphoric, not because they solve real problems. Survivors don't fall in love with ideas. They understand probability. Owning altcoins means accepting that failure is the default outcome. Principle 3. Cycles matter more than news. News creates noise. Cycles create opportunity. Crypto moves between two emotions, fear and euphoria. Despair convinces people the future is over. Euphoria convinces them risk no longer exists. Those who understand cycles do the opposite of the crowd. They buy quietly when optimism disappears. They reduce exposure when confidence feels universal. Headlines change daily. Human behavior does not. Principle 4. Position size is risk management. This is where most people break. No single investment should have the power to ruin your life. If it does, the position is too large. Smart investors expect mistakes. They survive them because their exposure is controlled. Crypto doesn't require perfection. It requires endurance. Survivors aren't the ones who make the best decisions. They're the ones who stay solvent long enough for good decisions to matter. How institutions approach crypto. Institutions don't chase pumps. They don't panic buy green candles. They don't FOMO into headlines. They build exposure. That single difference explains why institutions survive markets that destroy retail investors. When institutions approach crypto, they don't ask, how fast can this go up? They ask, how does this fit into a long-term portfolio? So they do things most individuals find boring. They allocate small percentages, not because they lack conviction, but because survival always comes before return. They rebalance periodically. They don't marry positions. They adjust exposure as conditions change, locking in gains quietly while emotion stays out of the process. They hedge risk. They assume volatility will happen. They plan for drawdowns before they occur. And most importantly, they think in decades, not days. Time is their greatest advantage. Patience is their edge. So when BlackRock, Fidelity, and pension funds enter crypto, they aren't gambling on price. They aren't trying to time tops or bottoms. They are positioning. Positioning for monetary shifts, positioning for technological adoption, positioning for optionality if the system evolves. Retail investors often make a costly mistake here. They copy institutional assets, buying what institutions buy, but they ignore institutional behavior. They go all in instead of sizing responsibly. They refuse to rebalance because it might go higher. They panic sell volatility institutions expect. Same assets, completely different outcomes. Institutions understand something retail often overlooks. You don't need to be right all the time. You need to be structured. You need to be patient, and you need to stay solvent long enough for long-term trends to play out. Crypto doesn't reward imitation. It rewards discipline. Copy the behavior, not just the portfolio, and you stop speculating. You start thinking like capital. Security, the part everyone ignores. In crypto, there is no customer support, no help desk, no recovery email, no manager to escalate to. There is no password reset, no undo button, no second chance. And that reality alone separates serious investors from those who are only passing through. Security in crypto is not optional. It's not an advanced feature. It's the foundation. Most people assume losses happen because markets crash, because prices fall, because timing goes wrong. But the truth is far more uncomfortable. Most losses in crypto have nothing to do with price. They happen because of human error. Poor wallet management, seed phrases stored carelessly, private keys exposed to the internet, fake links that look real, phishing sites that mimic trusted platforms perfectly. One click and everything is gone. And emotional mistakes, rushing transactions, skipping verification, acting under pressure instead of clarity. In traditional finance, mistakes can be reversed. In crypto, mistakes are permanent. That permanence is not a flaw, it's the price of sovereignty. Cold storage isn't paranoia, it's responsibility. It means choosing safety over convenience, process over speed, preparation over impulse. Because self-custody changes the rules. You are no longer protected by institutions. You are the institution. And institutions don't operate on hope. They operate on controls, procedures, and redundancy. If you can't protect your assets, you don't truly own them. Ownership in crypto doesn't come from possession alone. It comes from discipline. And the market has no sympathy for those who confuse freedom with carelessness. The psychology of long-term winners. The best investors are boring, painfully boring. They don't post screenshots of gains. They don't announce entries. They don't seek validation from strangers online. They don't panic sell at the first sign of volatility. They don't celebrate green candles like victories. They don't argue in comment sections trying to prove they're right, because they understand something most people never learn. Wealth is built in silence. Losses are loud. Winning investors don't need attention. They need time. Crypto rewards patience more than intelligence, and it punishes ego faster than any other market. Ego demands action. Ego wants to be seen. Ego needs to feel right, even when it's wrong. Patience does the opposite. It waits. It observes. It lets probabilities work. The best investors don't try to win every trade. They know that's impossible. They expect drawdowns. They expect volatility. They expect to be wrong, often. What they don't do is let a single decision define them. They don't overreact to noise. They don't confuse movement with meaning. They don't let social pressure push them into bad timing. Because the goal was never perfection. The goal is survival. To stay solvent through downturns. To stay rational through euphoria. To stay disciplined when emotions are highest. Crypto doesn't reward the loudest voice in the room. It rewards the calmest. Those who last aren't the ones who predicted the future best. They're the ones who managed themselves best. Stay in the game long enough, and patience becomes compounding. Lose control once, and the market reminds you who's in charge. Crypto is not a shortcut. It was never meant to be. It's a test of discipline, because doing nothing at the right time is often harder than doing something. A test of education, because surface knowledge gets punished and shallow conviction collapses under pressure. And a test of emotional control, because fear and greed move faster in crypto than in almost any other market. Most people fail not because the opportunity isn't real, but because they aren't prepared for what the opportunity demands. Those who pass this test don't just make money. They gain perspective. They stop seeing price as the story. They start seeing structure. They understand that volatility is the cost of admission. That uncertainty is not a bug, it's the environment. And that risk is something to be managed, not avoided. Because the real opportunity in crypto isn't just financial. It's witnessing, in real time, how the future of money is being written, block by block, transaction by transaction, rule by rule. For the first time in history, the rules are visible, the ledger is open, and participation isn't restricted by geography or status. But access alone isn't enough. If you approach crypto impatiently, it will feel like chaos. If you approach it emotionally, it will feel unfair. But if you approach crypto with patience, with clarity, and with respect for risk, you don't need luck. You don't need perfect timing. You don't need to predict the future. You need a strategy. Because markets don't reward hope. They reward preparation. And crypto, more than any other system, forces you to become disciplined before it allows you to be rewarded. Pass the test, and the returns compound, financially and intellectually. Fail it, and the lesson is still paid for, just at a higher price.